Hello, this is Professor Kern, and today we are going to be working a basic earnings per share problem. Basic earnings per share is covered in intermediate financial accounting, and this is a sample exam problem. And I'm going to be working this using both the time-weighted number of shares approach to calculating weighted average number of shares. And I'm also going to be working this problem using the time-weighted changes to number of shares, which you can also use to calculate the weighted average number of shares. So let's get into working the problem. So RAS Corporation was organized on January 1st, 2021, with 1 million authorized $1 par common shares and 100,000 authorized $100 par 12% cumulative shares. And during 2021, the first year of operations, the corporation had the following capital transactions. They issued 500,000 common shares and 50,000 preferred shares for $9,875,000. They repurchased 200,000 shares of common stock at $26 per share. They paid a 10% stock dividend on outstanding shares on June 1st. On September 30th, they sold 50,000 treasury shares at $30 per share. And on December 1st, they sold 100,000 treasury shares at $20 per share. RAS's net income for 2021 was $2 million. And the question asks us, what was RAS Corporation's basic earnings per share in 2021? So to work this problem, we must first visit the formula for calculating earnings per share. And the equation for earnings per share is net income minus preferred dividends divided by the weighted average number of shares. So what's important to remember about this equation is that we only care about the common shares. We're only going to allocate earnings per shares over the common shares. And we're only going to do that over the weighted average number of common shares outstanding. So we should remember that these are common shares. So now let's go through each of these items and determine what they are. So net income is equal to $2 million. It is given in the question. Then we have to figure out what our preferred dividend is. So the question doesn't tell us if a dividend was declared or not, but the question tells us that the preferred shares are cumulative. If they're cumulative, we're going to subtract the preferred dividend whether it is declared or not. Because even if it's not declared, the company would have to pay these preferred dividends in future years in which they declared dividends. So we're going to always subtract off the cumulative preferred dividend. If it's non-cumulative, if the question said non-cumulative, then we wouldn't subtract it off. But it's cumulative in this case, so we will subtract it. So the way we calculate preferred dividends is we're going to take the par value, and this par value is $100, and we're going to multiply it by the number of outstanding shares. although they have 100,000 authorized shares, they only issued 50,000 preferred shares during the year. So we're going to multiply by 50,000, not 100,000. You need to make sure you only account for the outstanding preferred shares, which this dividend would be paid on. And then we will multiply by the 12% rate. When we do that, we'll end up with $600,000 preferred dividend. So now the final step is we have to calculate the weighted average number of shares. Like I said, I'm going to work this using two different methods: the time-weighted number of shares and the time-weighted changes to the number of shares. And using either approach, you will get the same answer. So to do this, we're going to make a table. In our table, we're going to have date. We're going to have number of shares. We're going to have number of months. And we're going to have the weighted average. All right. So on January 1, they issued 500,000 common shares. So we're going to use the date of January 1. Then for the number of shares, we'll write down 500,000. But let's remember that on June 1st, they paid a 10% stock dividend. When a company pays a stock dividend, we have to apply that stock dividend to all the share increases and decreases prior to the date of the stock dividend. So we need to multiply 500,000 shares times 1 plus 10%, or 1.1. And that would give us 550,000 shares. 550,000 shares. The number of months that they had 550,000 shares was January, February, and March. So 3 months out of 12 months. So the weighted average shares during this time period for these 3 out of 12 months would be 137,500 shares. I will briefly go over to my paper so you can see the numbers better. And that's what we would do for the January 1st time period through March 31 time period. Okay, now on March 31st, they repurchased 200,000 shares of common stock. So using the time-weighted number of shares, we'll take 500,000 shares minus 200,000 shares. We'll multiply this by 1.1. This will give us 330,000 shares. They had 330,000 shares for April, May, June, July, August, and September. So that would be 6 months. So the number of months would be 6 out of 12 months. Our weighted average number of shares during this time period would be 165,000, 165,000 shares. Then on September 30th, they sold 50,000 treasury shares at $30 per share. So when a company sells treasury shares, we're going to increase the number of outstanding shares. So on September 30th, we're going to take 330,000 outstanding shares and subtract 50,000. That'll give us 380,000 shares. I apologize. I think I said subtract just now. I meant add the 50,000 shares, and that will give us 380,000 shares. You will then multiply the 380,000 shares by the number of months, which they had 380,000 shares, which would have been October and November. So 2 out of 12 months. So the weighted average number of shares during this time period would be 63,333.33 shares. And then for December, on December 1st, they sold 100,000 more shares. So we would take the 380,000 shares plus 100,000 shares, and we would get 480,000 shares outstanding. And we would multiply this by 1 out of 12 months for December, and we would get weighted average number of shares of 40,000. Then we would just sum up these weighted average shares, and we would get 405,833.33 weighted average number of shares. So now I'm going to go back to the paper so you can see this method a little bit clearer. So this approach would be the time-weighted number of shares approach. This is the time-weighted number of shares method. All right, so now I'm going to work the same problem, the same weighted average number of shares, but I'm going to use a different method. This time, I'm going to use the time-weighted changes to the number of shares approach. So when you use this method, you want to just count the number of months until the end of the year on each date that the number of shares changes. We're not going to count the total number of shares. We're going to just track the changes and multiply the changes, the change amount, by the remaining months in the year. So again, I'm going to have a date column. I'm going to have a number of shares column. I'm going to have a number of months column. And I'm going to have a weighted average column. So on January 1, they had 500,000 shares. Well, let's remember that on June 1st, they paid a 10% stock dividend. So we have to multiply the 500,000 still by 1.1. So we'd have 550,000 shares. The number of months until the end of the year is 12. So 12 out of 12 or 1. So the weighted average number of shares is 550. Then on March 31st, they repurchased 200,000 shares of common stock at $26 per share. So here we're going to do minus 200,000. And remember, we have to multiply by the 10% stock dividend, or by 1.1, and we'll get minus 220,000 shares. So here, there are only 9 months remaining until the end of the year, because we've already passed through January, February, and March. We're going to multiply by 9 over 12 months, and we'll get a subtraction of 165,000 shares for the weighted shares from that change. Then on September 30th, they sold 50,000 treasury shares. So our shares are going to increase by 50,000. Then we have to count the remaining months until the end of the year. So that'd be October, November, and December. So that would be 3 out of 12 months. So the weighted average number of shares here would be 12,500 shares. Then on December 1st, they sold 100,000 shares. And there's only 1 month remaining till the end of the year. So we do 1 divided by 12. And that would give us a weighted average shares for that time period of 8,333.33. Then if we sum those up, we get the same answer. We get 405,833.33 shares. So you can see in both methods, we get the same number of shares. So you can use either approach to calculating the weighted average number of shares. And this I'm calling the time weighted changes to number of shares method. They can use either one when calculating the weighted average number of shares. Okay, so now we have to compute EPS. So we had net income of 2 million. We had a preferred dividend, so we have to subtract out our preferred dividend of 600,000. Then we are going to divide by the weighted average number of shares, which we calculated to be 405. 833.33 shares. That will equal $3.45 per share. If you have any questions related to working earnings per share, I'm in my office on Tuesdays and Thursdays from 9 until 3:30. And on Fridays, I'm available from 9 to 11. You can also email me any questions to jkern@ou.edu if you need help with this or any other financial accounting related topics. And I look forward to seeing you in the next lesson. Take care.